You must be a bit tired with the Brexit issue, so I don't exclude it for Q&A, which will come. But my topic is also an important one, a serious one, about monitoring financial stability along active monetary policies. And so I will share some thoughts on this delicate issue with you. Price stability and the prevention of financial imbalances are often two sides of the same coin. Indeed, price stability and financial stability are supposed to be complementary and mutually beneficial. During the recent crisis in the euro area, the transmission mechanism of monetary policy was hampered by a fragmented interbank market as borrowing conditions were deteriorated in stressed countries, mainly in Southern Europe. The resulting deterioration in the economy, in turn, contributed to a further worsening of the financial stress in what we specialists call a real financial feedback loop. But to cope with this difficult situation, the policy response in the euro area was twofold. First, we adopted, as you know, an active monetary policy and launched unconventional measures that included the credit easing package. Second, and this is as important, we set up a banking union and assigned new macroprudential powers and tasks, both at the European level, the ECB, and this ESRB, European Systemic Risk Board, of which the two of us, Richard and myself, are members. Which is perhaps less known, there were also measures at the national level. In France, for instance, the Haut Conseil de Stabilité Financière, High Financial Stability Council, was created in July 2013 as the French authority with the legal ability to impose binding macroprudential measures. I don't know if Hélène Rey is with us. Hélène is a very qualified member of this Haut Conseil de Stabilité Financière, so I feel almost at home this evening. The economy is now recovering after this severe crisis, so the medicine seems to have worked, this twofold medicine which I just mentioned. However, our attention is now turning to the potential side effects of our treatment. Monetary policy in the euro area is maintaining short-term nominal interest rates at very low level. And due to our forward guidance, rates are also very low up to medium-term maturities. But as the economy is recovering and as we are progressing towards our inflation target, the Governing Council clearly decided on October 26th to pursue the gradual normalization of our monetary policy. We will continue along this road, but financial stability concerns could be increasing according to some. It has recently been argued that this long-lasting low interest rate environment could result in unwanted side effects in terms of asset prices misalignments or spur a search for yield that would entail excessive risk-taking. This issue of the side effects of monetary policy is not entirely new. Monetary policy is never neutral, since it works its way through to the real economy via its effects on financial conditions. That is to say, the current and the expected cost of borrowing liquidity, and in turn, its effect on asset prices and risk premia, even in normal circumstances. I will try to elaborate tonight on 4 issues. First, to share with you some remarks on bank profitability, which is not the only issue of financial stability, but which is very often mentioned as a side effect. Second, some remarks on price of assets and the financial cycle, which is probably the other frequently mentioned issue. Then, as a third point, I will come to policy making and the kind of relation we have to organize, and it's an open discussion, between monetary policy and what is called macroprudential policy. I will elaborate on that. And fourth, I will share with you some remarks and proposals on how we should now complete the regulatory agenda we elaborated at the international level since the crisis and since the London summit here in this city in 2009. Let me start with the issue of bank profitability. It is true that low interest rates may affect the interest margins of banks, since these banks cannot generally pass negative rates on to depositors. Also, because these financial institutions engage in maturity transformation, both the slope and level of the yield curve matter for their profitability. But let me comment on what I see as the predominant effects of interest rate cuts since 2014. Our monetary policy is driving up real asset prices and lowering debt servicing costs. Indebted corporations, indebted households and governments can so improve their balance sheet and yet maintain a steady spending trajectory with improved growth prospects. On growth prospects, the ongoing recovery in the euro area has been synonymous with lower unemployment, you see it on the left, and this is an impressive figure. 7 million jobs have been created in the euro area since 2013, resulting in higher disposable income. In turn, this has significantly lowered the risk of default borne by the banking sector. Banks have also benefited from very low interest rates through cheaper funding and significant capital gains on their long-term assets. So far, I stress this so far, these positive effects seem to have compensated for the reduction in the bank interest margins. In a recent ECB working paper by Altavilla, Buccina and Pedro, the authors even argue that there is no causal relationship between low interest rates and reduced bank margins. The latter effect, reduced bank margins, is due more to the past deterioration in macroeconomic conditions than to active monetary policy. So, a comprehensive assessment of our current policy package should not only look at the intended consequences and the side effects that can be observed, but also weigh them up against what would have happened in the absence of our exceptional policy. And this is the next slide, and what economists, as you know, call counterfactual. What would have happened for growth or for credit spread if we hadn't had this active monetary policy? And here are some estimates at the ECB level, which we more or less all NCBs agree upon. How profitable would our banking system now be had we not eliminated the 2014-15 deflation risk? The landscape for our banking system would very probably have been somewhat dire. In a deflationary environment, and we must be serious, there was a risk of deflation, and we have avoided this lethal danger due to our monetary policy. In a deflationary environment, the debt servicing cost for borrowers is heavier in real terms. Defaults are more frequent, and less sustainable debts result in higher credit spread. The risk of a debt deflation spiral then increases further. But this has been avoided in the euro area, and if the price of this is a temporary reduction in bank interest margins, then it is worth incurring such a secondary side effect. Let me now turn to my second point about the price of assets and the financial cycle. At the level of the euro area as a whole, we consider the financial stability situation to be overall under control. The solvency ratios of significant euro area institutions have improved continuously since 2014, reaching 15%, 15% on average in Q2 this year. Overall, private debt in the Eurozone diminished, which is not very well known, diminished as a share of GDP, 128% in 2011, before this active monetary policy, 122% today, so diminution of private debt. Non-performing loan ratios have also declined, especially for small and medium-sized enterprises. Can I, on NPL, add an important point? I strongly support the recent SSM initiative to provide new provision rules for NPL flows, so the new NPLs which would appear in banks' balance sheet. You are perhaps aware that there has been strong criticism against SSM and ECB and against SSM chairwoman Danielle Mouy following this proposal. But I think they are accurate and that this criticism are unfounded. Moreover, after some years of subdued financial cycles, most cycles in euro area countries have normalized. And in some countries, they have even accelerated. And here you see the ECB estimate of financial cycle, the blue line being the median estimation across countries. To be frank, and I will come back to that, the acceleration of the financial cycle is the case for France. Should it be a concern, I will share with you some elements on my home country, which is an interesting textbook. In France, asset prices are currently rising in a context of low market volatility. Since low volatility and abundant liquidity may encourage risk-taking behavior alongside search for yield behavior, we must be vigilant against the risk of a widespread mispricing of financial assets that could, we are not there, could hinder the economic recovery. I give you some numbers in France. Residential real estate prices are back in positive territory, with year-on-year growth of 2% in real terms. The commercial real estate sector is still buoyant. But our alert alert is on non-financial corporation debt. It's now more than 74% of GDP against 62% in 2010. And overall, private debt in France, I said that in the euro area it's decreasing as a whole, but private debt in France now amounts to 130% of GDP. This shows that there can be different situations from a country to another, and I will come to that macroprudential policies have an important domestic or national dimension. I do not want to bombard you with further numbers on France, but the main difficulty for us as policymakers is to try to disentangle from these positive figures what is a desirable consequence of our monetary policy, and these are positive figures, and what could be signals of a potential financial risk we would have to address. And this brings me to my third point for policymakers. What is the relation, the combination between monetary policy and macroprudential policy? As I said, overall, private debt in the Eurozone has diminished. But in some countries, the financial cycle is picking up, while at the same time, inflation has been slowly increasing, but remains below our target. So in that case, there is not a full convergence between price stability objective and financial stability objective. How does the academic debate first resolve this issue? Already before the 2008 crisis, central bankers firmly believed that price stability is a necessary, and for some even a sufficient, condition to ensure financial stability. This view is referred to as the Jackson Hole consensus, and you are well aware that Jackson Hole in Wyoming is the temporary capital of central bankers during August for 3 days. It's the American Sintra, and Sintra is the European Jackson Hole. This is a very simple rule. Jackson Hole consensus, following the financial crisis, financial imbalances were seen as a huge source of disruption which decision makers needed to remedy, questioning the relationship between monetary and financial policy tools and objectives. On this relation, let me give you two polar views, and they are extremely polar. A first approach, which would be a strict application of the Jackson Hole consensus, is to clearly separate monetary stability from financial stability. In line with the Tinbergen rule, one objective, one instrument, and the Mundell efficiency principle, respectively, one policy should fulfill one objective, and each policy tool should be assigned to the objective it can fulfill the best. In this regard, monetary policy would not be efficient at mitigating financial imbalances, but would not generate them either. Separation rule and macroprudential policy is designed to address financial stability objective. On the other side, and I said these were two polar views, an extreme approach is to consider that both policies are strongly intertwined and that their respective objectives could be merged. In this case, monetary policy could reduce risk-taking and target asset price bubbles. I consider that full adherence to the separation principle on one side and the combining of objectives on the other side are both approaches that are too radical to conduct monetary and financial stability policies. The implementation of unconventional policies has blurred the frontier between the two objectives. Blurred, but not suppressed. And let me quote here my colleague from the Governing Council of the ECB, the Vice President of the Council, Vitor Constancio, in a recent speech. I quote him: "Macroprudential policy and monetary policy rely on separate tools and aim to achieve different objectives. Yet, they need to be coordinated, which is not a trivial task." Unquote. This is, according to me, a wise view. Keeping monetary policy aligned with its primary objective of price stability, but not blindly sticking to the separation principle, may help us to manage our two main objectives and strengthen our credibility. How do we implement this coordination in practice? As you may know, the Banque de France, and I will illustrate it with the example I know best, the Banque de France, like many other central banks, has had, and this is new, the dual mandate of maintaining price stability and preserving financial stability since 2013. And so you notice that this is a quite recent evolution following the crisis. The financial stability mandate is demonstrated by the fact that the governor of the Banque de France has the sole right and responsibility to make proposals for implementing macroprudential instruments to the High Council for Financial Stability, which I mentioned, and which is the French macroprudential authority, chaired, as a matter of fact, by the finance minister. And I think it's a good balance. I consider this specific role assigned to the governor of the Banque de France as an opportunity to make price and financial stability objectives more consistent. Let me elaborate a bit. First, macroprudential complements the monetary policy framework decided at the euro area level by adjusting it to national specificities and addressing idiosyncratic, specific financial stability risk while maintaining the harmonious transmission of monetary policy across the euro area. Second, macroprudential policy may help to fine-tune the overall impact of monetary policy by ensuring that the risk-taking channel is not disproportionate in some specific sectors or countries. Can I give you two very concrete illustrations of that, which are, again, idiosyncratic or specific? You will see that they can even be still more local than national. We had an alert last year on the price of commercial real estate, not throughout France, but in Paris. And then we issued an alarm. We introduced stress tests with the financial industry. We decided not to go to the end, to macroprudential measures, because the results of the stress tests were limited, but it was clearly a published alarm and awareness. And we have now an issue, which is probably more important, which is corporate debt. I mentioned it, large corporate debt, which is very strong and evolving at a rapid growth in France. So we will deal with this issue in our next meetings. Having said this, I do not mean that there is no hierarchy between the two objectives. I call for strong complementarity, not for a merging of objectives. To be more explicit, I consider that a monetary policy strategy that would target asset prices would be a mistake. As central bankers, we need to avoid confusing economic agents. Our role is to anchor expectations and ensure business continuity. Let me come to my fourth and last point about the challenge which still need to be addressed about the financial regulation, what we need to complete. For financial stability to be more effective still, we face a number of challenges in order to achieve an optimal regulatory framework. First, we have to complete the regulatory framework for banks by finalizing the Basel III reform. It is my strong wish and hope that we can reach a fair and reasonable agreement soon. A revision of the European macroprudential framework is currently underway at the European Commission level, and this is welcome. Moreover, decisive progress should be made to better provide macroprudential authorities with policy tools properly designed to address financial risk beyond banking. And here, I think to shadow banking, fintechs, pension funds, financial innovations. They bring opportunities, but they are all part of the scope of macroprudential policy. Our next issue is probably less the solvency of banks than the liquidity of non-banks. It is also our duty to complete the European regulatory framework with the finalization of the resolution mechanism to make the functioning of the banking sector smoother, in line with the spirit of the banking union, also enabling the capital markets union to bloom within the holistic approach of what I suggest to call a financing union for investment and innovation in Europe. And this could be one strong accelerator of the economic union in Europe. Finally, we must ensure that the new regulatory framework is consistently implemented everywhere. and avoid any backtracking outside Europe. When I say outside Europe, financial stability is, I didn't say anything. Financial stability is a global common good, and as such, regulatory arbitrage must not become an option. Let me conclude. Credibility for central bankers is a key value. It now rests on admitting that monetary policy and macroprudential policy are somewhat porous, especially in a situation where we could have an upward financial cycle associated with weak inflation. This calls for a consistent action by central banks that covers both areas, price and financial stability. Moving away from an overly strict separation principle, but keeping the hierarchy of objectives I mentioned, let us try to be complete and consistent central bankers, playing an active role both in monetary policy as well as macroprudential policies. Thank you for your attention.
And thank you very much, Governor. You raised and covered such a wide range of issues that, but in some depths, all the same. So it's not easy for me to do a start-off question, but still, I'll pick one that's close to my heart, as you know, about shadow banking and about the point that you raised, the concern that you raised about the liquidity of non-banks going forward. Could you elaborate on that a bit? What worries you?
First, I share your question, Richard, as you know. Let me make 2 or 3 quick points on that. First, we have a problem of definition of shadow banking.
Yes.
And banks tend to have a very wide vision of shadow banking. Shadow banking would be everything which is not banks. And they have a very simple vision saying we should apply to non-banks exactly the same rules and regulations than to banks. This is not your views, this is not mine, but this is something we hear. So we should focus on the real risk of shadow banking and elaborate a bit. If I look at the insurance sector, I think this is not your point. It has been regulated, especially in Europe, thanks to Solvency II. We probably have an issue with asset managers. And this is the example I will take and which we will probably share. But it's not an issue on solvency, and I precise it for non-specialists. When we speak of solvency, it's the issue of capital ratios. It doesn't make sense to apply the same capital ratios to asset managers than to banks, because they don't have the same risk. If you are the client of a bank, you lend, so you have a bank deposit, you receive a guarantee from the bank. So the risk is in the bank. If you are the client of an asset manager and you buy shares of a fund, it's your risk. You have no guarantee. So the need for capital is not the same. If there is a deterioration of market conditions, an abrupt one, and if you are the customer of an asset manager or of an asset fund, the risk is for you, obviously, you know it. But you will tend to sell your shares. And if all customers come in the same week, let's say, then we have a fund run. And the key issue is how does this asset manager manage liquidity? There could be what is called gates, that you don't have a full liquidity guarantee, so you have to wait if you are the customer. Or there could be liquidity provisions at the asset manager level in order to guarantee that they can face such sudden and general withdrawals. But we have to deal with this issue. There are some individual provisions for asset managers. They have answers, but these are individual answers. And one of the things we advocate very probably together, Richard, is to have what we call systemic stress test. If there is a general market deterioration, and if all the customers or a vast majority of customers withdraw their investment at the same time, which is a different story from individual withdrawals, what will happen? The FSB, Financial Stability Board, chaired by the Governor of the Bank of England, Mark Carney, made precise recommendations about the organization of such liquidity, systemic liquidity stress tests. Now we have to implement them. So it's, I think, a fair example. There are others. So it doesn't mean that everything which is not bank is shadow banking. It doesn't mean that we have to transpose exactly the same banking regulation. This is clearly an excessive view, but we have to focus on the specific risk of this sector.
Okay, I've now done my introductory question. It's completely open. Please, in the front row here. And perhaps give your name and institution if that's appropriate.
Ranjiv Gunawardena, Chairman of International Consultants. My question's based upon the gold bullion. In the old days, you had gold as a standard for...
I wasn't born yet.
Oh, fair enough. Fair enough. The key idea is that at that time, gold prevented all sorts of volatilities in the marketplace. So the question that I pose to you is that with the modern days where gold is not that much strategical investment, is it coming back in terms of gold bullion storage and facility and on your balance books?
It's an interesting question if you look at long-term history, which is always very useful in finance because we tend to forget what happened earlier. So the gold bullion had advantages, including stability. It was a clear anchor. It had also limitations, like all metal currencies. And if you look still in a more remote past, so before the Bank of England, before the banknotes, we only had metal currencies. And the main drawback is that the economic activity or the money supply is strongly dependent on the metal supply, be it gold, silver, or any other. And this is a strong drawback because there is no mechanical relation between the metal stock and the GDP or any economic indicator, especially when growth accelerates. And this was the reason for the development of banknotes. And there are other reasons, but at the end, if you look at the American economy, it's the main reason for abandoning the gold bullion. So I don't think that the future should always be cautious, but I don't think that the future is going back to the past. But if I take something from your question, where we will agree, is that we need some anchor. We need some anchor. Currency and monetary policy is about credibility. And this is our first and foremost duty, to be credible and to give trust in the currency. And for us, this anchor today is price stability, clearly. I didn't elaborate much about the objective, but just one sentence. We have a price stability is, in the case of the ECB, our duty, our mandate, according to the treaty. We cannot choose another anchor. And the definition of price stability, which was elaborated in 2003, so it was well before Mario Draghi, is a slightly positive inflation of, in a midterm perspective, close to but below 2%. And this is not by chance. The definition of price stability is today exactly the same in the Bank of England, in the American Fed, or in the Bank of Japan. What Jean-Claude Trichet, sometimes one of my predecessors, sometimes calls the great intellectual convergence. So this would be probably the modern answer to your point. The anchor with metal would be probably detrimental, but we need an anchor, which is an economic anchor, which is price stability. It's why our mandate is so important, because sometimes people say, why do you bother with price stability, etc.? Why is it that important? It is very important.
So do you hold bullion yourself? Do you hold bullion on your balance sheet?
Yes, we do. We do.
Is it on the increase or decrease?
It's completely stable.
There we are.
No, because it's very difficult to say, and I'm not sure it makes much sense
Mike
to
down
buy.
here, please. This gentleman, that's it. The one with his hand up. The last hand remaining. Go ahead. No.
Thank you, Boris Filipnitsky, Barclays, and part of the London Business School Executive MBA program. Thank you. First of all, thank you so much for coming here. It's a real pleasure to listen to you. Quick question for me. So yesterday you were in Frankfurt gave a pretty interesting speech. So over there, you made the point that Europe should create more VC funds and increase the share of private investment. And here you made the point of some liquidity guarantee for asset managers. So how did the two of those points come together?
First, thank you very much for reading my speeches. Second, I guess it's a different story. I didn't speak of liquidity guarantee for asset managers, liquidity provisions, right, which is not the same. And if you introduce systemic stress test, as I mentioned, probably the solution lies with the asset managers themselves. They have to introduce the safe liquidity rules in order to protect in case of a fund run. So I wouldn't advocate, and I think that none of us here would advocate some kind of public and especially illimited guarantee. Coming to venture capital, why I stress this, I will be very short, is that if you look at European economy financing, what we lack is equity, above all. The most important transatlantic gap is this one. If you look at corporate equity compared to GDP, you are probably aware of the figures, 128% in the US, and in the euro area, 68%, so a bit more than half. And equity financing is an absolute key when you are in an innovation-driven economy, because you finance innovation, which is much more risky, through equity more or rather than through debt. And here I come to European venture capital. I don't know, but you know the figures still better than I do. If you take I will be very simple. If you take the 10 first American venture capital funds and the 10 first Eurozone venture capital funds, the size of the 10th American fund is about 5 times higher than the first Eurozone venture capital. So when you look at this, you understand the problem. And it's not a huge problem, it's not a systemic problem on liquidity, so these are really two separate issues. It's not a problem of financing the startups. We made decisive progress on that in France and elsewhere. It's more a problem of financing the scale-ups. When you are at your third or fourth round, capital increase, you need 100 million euros or 150 million euros. You need a significant investor by size. And it happens to be American more usually than European.
In the back row, there, that's the gentleman there.
Thank you. Michael Foster, I'm a private individual. One of the questions which is frequently asked in the Brexit topic is with regard to London as a financial centre and the future positioning or requirement for banks to relocate operations or individuals or risk or so on into the Eurozone. And it seems to be there is a variety of opinions expressed by various of the European authorities as to whether back-to-back trading would be permissible, or whether the hearts and minds of the institutions have to be relocated into Europe, or something in between those two, or whether the day one position versus the position in year 5 may vary. So I'd be interested in your perspective on that, and also as regards the requirement to move European clearing into the Eurozone.
So this is a Brexit question. It was expected. I will try to be very short. I had the opportunity to give a speech at lunch, I must confess, on these issues. So you can also read this one. It's by chance. No, but to answer your questions, very probably, or certainly, the EU, the 27, the 19 in the Eurozone agree on 2 very simple principles, which are probably the best answer to your question. And I will focus on banks, but it's not very different for insurance. First, and we clearly wish that there is an agreement, a fair and positive agreement with UK after Brexit. It's not a question of punishment at all. We have no interest, and nobody has an interest to punish the UK. The issue we have, and this is the first issue, is an issue of consistency of the single market. We have built the single market, thanks also to a strong British commitment, with a clear link between access and rules. It's as simple as that. The single market is not only a free trade agreement, it's a balance between access and common regulation, what is called the single rule book. If I apply it to financial services and banks, it means that you can hardly hope to have a European passport if you don't implement the common rules. And this is the basis of what you call the relocation. Will be only about part of the financial activities today run in London, the one dealing with European savings. And the second principle, and here the SSM, so single supervisory mechanism of the banking union in Frankfurt, has been very clear, is that for this part, and again it's only part, which will be relocated within the single market, dealing with European savings, no empty shell. So this example of back-to-back is probably not a solution consistent with the SSM view. But I strongly hope we can find a positive agreement, and I have no doubt that anyway London will remain a major financial center, but we will probably see some kind of Europeanization of the transformation of European savings. Clearing it, I would say it's the same principle, and again I want to be very short. As you can imagine, the euro is our currency. There are other European currencies, but let me focus on the euro. What happens in clearing is very important for monetary policy and for financial stability, the two objectives I mentioned, especially in crisis times. So it's very difficult to imagine that beyond a certain size, what the European Commission in its proposals calls super systemic clearing. Beyond a certain size, clearing activity in euros would be beyond the supervision of the EU. And this is why the Commission proposal, supported by most member states, advocates for super systemic CCPs a relocation policy.
Robert Jenkins, I'm a professor here at LBS and chairman of the CFA Institute. Thank you very much for coming tonight. You mentioned the counterfactual. What would have happened had central banks not taken the actions they did? Have you looked at the counterfactual in another way? What would not have happened in 2008 if central banks had moved rates up more aggressively from 2003 onwards than they did?
It's a fair question. Technically, I don't have the answer, but probably this counterfactual exists. I guess that your question is mainly American. Am I right?
That would be a good place to start.
Thank you. And I don't want to quote any family names, but we were probably thinking of the same person, whom you should ask a question to. So I don't know, because there are very distinguished economists in this room, if there has been this counterfactual for the past. And you are probably right, that monetary policy, seen from today, was not optimal before crisis. It has its share of responsibility, not the only one, in what happened. But the question we had was not this one. When you are after the crisis, with a real depression, with a risk of deflation, the question is not what you should have done 10 years earlier, it's what you should do now. And in this sense, the counterfactual is important. Two quick remarks on that. As you know, there are differences around the Eurozone about the degree of accommodation of monetary policy. And some countries or some central banks are less convinced than others. But on the counterfactual, interestingly, everybody agrees about the measurement of effects of monetary policy. To give you a very simple figure, our estimate is that the effect of unconventional monetary policies is about 0.4% additional inflation and 0.4% additional growth each year between 15 and 18, which is another way of presenting the graph I showed. So there is a technical agreement on that. And my last remark, and here we will probably all agree, if we look long term, as you did, and we look at the financial crisis of 1929 and the financial crisis of 2009, the obvious difference, because there are many similarities between the two financial crises, the obvious difference was the monetary policy answer. And I don't say that the economic situation of this decade, 2010 and later, is buoyant. But without any doubt, it is much better than the economic situation of the 30s. Because we escaped the mortal danger of deflation thanks to monetary policy. So I accept the debate about side effects. I accept the idea that in such or such cases there could have been a debate. But the global picture for me is very clear.
I think we can take two more questions if they're brief. There's one in the back there and one in the front up here.
Thanks very much. Georgina Prodan from Reuters. You talked at the very beginning about the gradual normalization of monetary policy and the phasing out of unconventional measures and said we will continue down this road. Do you feel that, so what has been agreed and signalled now, do you feel the signals that the ECB has sent about how quickly and with what possible deviations this will happen have been the right ones? Because leaving the bond buying program open-ended has led to expectations from some sides that it may expand again. So that's my question. Do you think the ECB has sent the right signals and is going the right way?
First, let me say one thing. I never comment on my personal views, but I always explain our collective decisions. And I have no problem at all of explaining our collective decision of October 26th. I think it's consistent. I spoke of a gradual normalization, and I already used this expression many times, so there is nothing new here. Perhaps the additional point, I will be very short, the additional point I would like to make is that monetary policy is not only about one figure, which is the figure of monthly net asset purchases. The decision we took, as you know, at the end of October, is to divide it by half, from 60 billion to 30 billion. And this is a decisive step, without any doubt. But sometimes, perhaps attention is a bit too focused on this single figure. And I stress that monetary policy is not a solo. It's at least a quartet. If I look first at QE, there is not only the question of the monthly purchases, but the question of the stock that we will hold. And we said clearly that we would hold a significant stock for the necessary period of time. Second, the question of the level of interest rates, and they are very low and even partly negative. Third, the forward guidance for the future. And fourth, if necessary, liquidity provision, as we did still 1 year ago with the so-called TLTRO. So we have all this orchestra, so to say, or all these instruments we can play with. It's why I'm confident.
One final question, Hugh Francis.
Hugh Van Steenis. Well, as no one else has mentioned it, we should say, first of all, congratulations on winning the European Banking Authority with all the jobs.
Thank you.
So I have to ask you a banking policy
question. If the LBS wants to come to Paris, you understand.
So a banking policy question. You mentioned backtracking, and I'm not sure which geography you may have referred to. The US is obviously reconsidering its financial policy. And like any building project, there's always a few months of snagging. So if you look at banking policy, are there any particular areas that you'd say we probably need to sort of reevaluate, have we got the right calibration?
I guess there are two different parts in your question. What could happen in the US, and do we need as a whole an evaluation? I start with the second question. Yes, we do. And it's a sign of confidence, truth, credibility to evaluate ex post the effects of the regulatory changes. This is also, and Richard could comment, something we do at the European level and we do at the FSB level. And to give only you one example, there are many others, we agreed in the FSB about what we call a comprehensive evaluation framework. And we will apply it next year to first infrastructure financing and then SMEs financing, which are, as you know, two very sensitive issues. And we will study what were the effects of the new regulations across the board, worldwide, on these two very sensitive issues. And then we can use the evaluation frameworks for such other topical economic issues. We will see. The evaluations we have run till now show clearly that financial regulation has not had adverse effects on real economy financing. I say it for my country, but I say it with full confidence also for the euro area. Second, about the US. There has been a debate in the US following the new administration, but it already existed partly before, about the calibration of financial regulation in the US. Let us be clear, there are probably two very different parts in this debate. There is a domestic part, because, as you know, part of the financial regulation in the US is purely domestic. If I take two examples, the Volcker rule, which is about own trading and which is forbidden according to the Volcker rule, which is not an international rule, or what the Americans call the community banks. So the smaller local banks, should they apply to community banks the same international standards, and where is the threshold? Here the Americans are completely legitimate to say we change the rules. Another part is the transposition in the US of internationally agreed standards, be it Basel III, be it what we decided in the FSB, etc. And if you look, can I stress this? And most of you are British. If you look at the G20 London Summit, April 2009, I invite you to come back to the communiqué of the G20. I must acknowledge that inviting such a distinguished audience to read a G20 communiqué is not especially exciting.
Wow.
But it's really one of the most outstanding examples of international political commitment. And here, the G20 leaders in this city were conscious of their historical mission. And they gave to the technicians, and the technicians we are, a clear political mandate. This is our roadmap, so to say, and we can be rather proud, collectively, politicians, technicians, financial industry, of the implementation of the London agenda. What I see at present is that the Americans have been consistent in implementing this agenda. There is always a tendency from each side of the Atlantic to say the other side is less compliant. Broadly speaking, the implementation has been fair. And for the future, I hope, and I am confident that it will go further this way.
I'm afraid that we have run out of time. I know there are more questions, and I'm sorry we can't take them, but it remains for me to give personal thanks to you, François, for coming and for being so articulate and open and frank and so knowledgeable about the issues. And then the other François will give an institutional thank you, I think.
First, I'll point out how you said that London will remain a major financial center. You also reminded us how the G20...
Along with Paris.
Yes,
it's too late now to add anything.
No,
time was up. Time is up.
No, for central bankers. Central bankers word matter. I didn't say the major.
A major center.
Which is,
oh, that's right. But you also told us how the G20 was so efficient when they met in London, and we appreciate that. But more technically, I do appreciate, I think this is really interesting when it comes to central bank policy. It came through your words how the academic world and central bankers and politicians work together. And to great effect for us, as you pointed out. And that's the kind of exchange we like to see and we like to promote here at LBS. So thank you so much for coming here tonight. Thanks to you, Richard. Thanks to you, to the AQR Asset Management Institute for helping us organize that, and for your team in Paris as well. Francois, as it happens, is not done with his speaking tonight, but that shouldn't prevent us from having a good time together, and that's why you are all invited to join us 2 floors up. Going up the stairs, you can't miss the drinks. And with this, thank you so much, Francois and Richard.